With new all-time highs hitting the stock market, I know a lot of people get nervous that this is not a good time to start investing. Some people say that we're finally going to get the recession this year that was predicted for last year, and they expect stocks to fall and come back down to earth. And some people think stocks are so high that we need to see a 30 or even a 50% drop. So with that being said, if the worst does happen, well, what do you need to do as an investor? Well, for what it's worth, here's my plan. Firstly though on my list, you need to get yourself a hot drink. Trust me, it's all part of the process. Let me show you something on screen while I get this water going. Credit to Brian Feroldi on Twitter, who often puts together really useful threads for investors. Here's something called the cycle of market emotions. What you can see here is the ride that we go through as investors depending on what the stock market is looking like. We feel great on the way up and then we start to feel really bad on the way down, even giving up completely once things get really bad. At every stage, your mind is working against you, and it doesn't matter how long we've been doing this, we are all humans. So this first stage of getting yourself a cup of tea or a cup of coffee is exactly what I do if we have a serious stock market crash. You have to do everything you can to take your emotions out of it. It's always easier said than done, and even the professionals make plenty of emotional mistakes. I think a good example just fairly recently, Bill Ackman, super smart investor, buys into Netflix and then not very long afterwards sells his stake for a loss after a pretty poor earnings call. But then look where we are now. He's missed out on a huge run and cost his investors a lot of money. Now I don't think there's really any other excuse there in the fact that we're all human, so we're all liable to feeling these emotions. The key for me, and all we can really do, is notice when they're happening and make sure that we don't act on those emotions. Second on the emergency plan, you're going to take a sip of your coffee. And then I'll go back to why I'm investing in the first place and run through everything I can do to make sure that I can be successful. For me, that means doing all of the basic foundational stuff, like making sure I don't need this money in my investing accounts. So that's having enough in an emergency fund or just general access to cash. That's making sure that any debts you have are manageable, or even better, paid off entirely, especially if they're high interest ones. And also, even in worst case, if you lose your job, it's making sure that you're in an industry where your skills are in demand. And going back to that first part yet again, having some kind of access to cash, whether you call this an emergency fund or not, that gives you that buffer to reduce any kind of pressure on yourself to stop yourself from selling. Now, just on this point finally, I think it does get easier as you invest over longer time periods, but it's fair to say that investors in my generation haven't really felt pain like those who were investing in the dot-com bubble or the global financial crash. All you can do is learn from those times, but you might never really know how you feel until you experience it yourself, which is why this plan is just so important to stop yourself acting out your emotions. You have to make it really, really difficult to sell, and there's no better way, in my opinion, than making sure that all of those foundations are set and protected. They might be basic and they might seem simple to you, but in an emergency, they will be absolutely crucial. Okay, next up, a reminder to everyone that making predictions about the stock market is pointless and impossible to get right. When times are looking rough, you'll see the so-called analysts on TV say it's looking rocky and things will probably trend down. Likewise, when things are looking rosy, they'll say there's lots to be optimistic about and stocks are going to go up. The truth is, nobody knows the future and we are rubbish at trying to make predictions about the stock market. Let me show you something hairy on screen now to prove a point. No, seriously, it's called a hairy chart. I'm not starting my OnlyFans just yet. What you're looking at now is two things. The interest rate set by the US Federal Reserve is the solid line, and then these little dotted lines or hairs are the historical predictions made about those rates by highly paid professionals. What do you notice about the chart? And it does look hairy. Now you can see why it's funny. Basically, every time a prediction is made, they are so far from what ends up happening that it almost becomes a pointless exercise. With all of the data they have and all the money and expertise, their predictions may as well just be a finger in the air or an excerpt from today's horoscopes. Actual hogwash nonsense. Can't even say it. Actual hogwash nonsense pointless noise. That took me a few times to say. And you'll find the same things when it comes to predicting any company share price or just generally on the stock market itself. Lesson here, don't make predictions about the future, or if you want to make predictions, keep them to yourself and certainly don't bet any of your own money on it, or just don't make any YouTube videos. Leading on from this one nicely is the next step in the plan. Let's look at what actually has happened in the past to see what lessons that we can learn. We know investing can be volatile and will always come with some level of risk, or at least I hope we do. So what this means is that over a long investing career, we're probably going to experience multiple periods where the market dips. There's no knowing when they're going to happen, how long they'll last, and how low they will go, but we do know that they will probably happen. Over history, here's what that looks like. Take a look at the long-term history of bull markets and bear markets. This one is nice and simple to read. Since 1958, there have been 10 bull markets and actually 11 bear markets. The bull markets are these blue lines and the yellow lines are the bear markets. There's two things I think we can learn from this graph. Firstly, you'll make far more money if you just stay invested during both the good times and the bad times. Trying to guess when they will happen is a loser's game, and just when you think things can't get any higher or lower, they do exactly that. Secondly, if you start as an investor knowing that you'll experience a bear market, then you should be a bit better prepared than if you only expect things to go up. The investing game is all about managing expectations. The bottom line for me on this one is always, if you want those lovely long-term gains, then you'd better get ready for the times when your investments are in the red. It's the price of admission. If you want to ride this roller coaster, it will probably go up, there's a few loop-the-loops, and you might go down or backwards for some of it as well. Okay, next point I'd like to come back to in my emergency plan. For me, as a long-term investor, I know I have to stick with my investing plan. Leading on from the last point, there's no point in investing if I'm going to try and time the market and stop my regular monthly investment. I can only get that long-term gain if I make sure that I buy at the highs, the lows, and everything in between. I have to acknowledge that I have no idea if the market is cheap, expensive, or just average at any point. So I'll continue to make my deposits no matter what happens. Again, easier said than done, but I find it useful to look back on charts like this to show me what that actually looks like. This one comes from a blog called Of Dollars and Data, and it's a really useful one showing what a dollar cost average strategy looks like over the long term. If you invest like I do every month consistently, you will get the average price of the market. That average price over the long run will move forward, but there are no guarantees in the short term over a year or two. In the chart you're seeing now, these results were from two different investors. One of them got to buy the dip and one invested no matter what. The buy the dip investor actually got to buy at the perfect times. They saved up all of their money to do this, and the rest of the article is really interesting. I'll leave that one in the description for you to look at in any more detail. But anyway, the key thing to note here is that the boring old person with no clever finance knowledge who just continues to keep buying comes out on top. And it works because there's no emotion involved. They aren't trying to be clever, and they just get that long-term average share price, which ends up making them a very nice profit. One thing I would add here though is that, hey, if you have some spare cash lying around and you are a long-term investor, and we are in a huge bear market, then if you want to throw in some additional money, then go ahead. If that happens in 2024 or in the next few years, I'd consider adding in some more money on top of my monthly payments. But this is only something I consider so long as I'd always keep up with my monthly buys no matter what. And going back to the earlier points as well, it's only something I consider if everything else in my life was sorted too, and I didn't need that money for a very long time. Next point, leading on from this, if you're really cynical and afraid of a crash, you might think, well, why does the stock market have to move up even in the long run? And the answer is that it doesn't have to. The stock market does not have to move up in the long run, but it has in the past, and it's down to some really key points. Remember that when you're investing, you're buying shares of real companies out there who are making real money and growing their businesses. Not all of them are doing well, and there will always be plenty that crash and burn along the way. But as a collective altogether, the companies that do well end up providing a huge amount of value back to the market. Here's something that shows this very well. Again, I took this one from Brian Feroldi's post on Twitter. Here's where the returns of the market come from over time. In the short term, it's a mix of a lot of things and also driven a lot by the multiple. So that's really just the market sentiment at any one time. As you might know, a high multiple, like a high PE ratio, just means that a lot of future growth is already baked into the price at any given point. Now look long term, here's the really key thing here. Over the long run, the driver of those stocks that perform well is all about sales and profit. That's real money, better profit margins, and selling more and more stuff. Over the long term, we get better companies, better technology, greater profit margins, and this is really what drives things forward. I'd say that if you don't think that companies will get better over the next few decades, or if you don't think humans will make progress, then fine, go ahead and bet against it. But if you take that position, then what is the alternative? What is the best way to invest money and take advantage of global growth? Now, personally, I think you'd be making a terrible decision if you miss out, but hey, it's just my view. I'm not your financial advisor. Now, final part of my emergency plan is this. This isn't something you can really measure, and this will be something that's personal to you, but I remember that investing is just one small part of life. The money I choose to invest isn't money I need today to pay my bills while also leaving enough for holidays and enjoying myself too. In the worst case scenario, if I make no money at all over the long run, hey, at least I tried and I did my best. But if that was to happen, then there would be way worse things going on in the world to worry about. In the worst case scenario, I'd have a savings account with less money than I put in. It's not going to go to zero as an index fund investor, but it would still have something in it. But even after saying that, the last part of this plan is all about good financial habits. If you are able to invest at all, that means you already live below your means, you're able to save your money, and you're probably on top of your expenses. By just doing investing in the first place, you put yourself way ahead of most people who aren't even able to get out of that first stage, which is saving more money in the first place. So what I'm trying to say at this point is that investing is just one part of life. It's not everything, and I'm able to stick to my plan in an emergency because it really is just a small part of my life. If you make investing your whole identity and all you do is spend every spare penny you have on the stock market, I think you risk not enjoying life today. If you aren't enjoying life today, and then you also have to go through a massive stock market crash, I can easily see why you'd panic and just sell everything. But just remember, every time you sell your investments, there has to be someone else on the other side of that trade. And I bet, in the event of a stock market crash, there will be lots of very happy, smart investors ready to take your shares off you while you run away, never to be seen again. And on that note, see you in the next video. Happy investing.